Okay, all right, everybody. Give people a few minutes to shuffle in, and then we will get started with the show. We have a great panel today talking about team time and tenure, the liquidity event decision framework for business owners. As you can see on the screen, we have a panel of experts that focus specifically on these things. We have Mike Morales, Sean Flynn, Matt Cohen, and this panel will be moderated by Mike Ross of Lattice Wealth Management Group. In just a few seconds, we're going to do a few intros, but I want to cover some housekeeping items before we do that. This panel is live and interactive. If you have questions, send them through. We are happy to answer your questions. If you want to get in touch with any of the panelists during the webinar, preferably after the webinar, we're going to enable you to do that, and we're going to put up some polls to help you tell us, yes, I definitely want to be in touch with them. So look for that throughout the webinar. We're going to be talking about taxes, selling a business, buying a business, what to do when that happens. This is all about liquidity event lessons. So without further ado, I'm going to switch it over to the moderator, Mike Ross. Okay, take it away.
So, ladies and gentlemen, looking at our pictures, you can tell that we're not going to do a presentation on middle-aged men hair products or hair care. Ryan, why don't you go through some of the bio ones? Why don't you hit me with the first bio page? And I think it's Sean. Sean, give us 30 seconds to a minute on what you do while people look at your background.
Hi, everyone. Thank you for having me here. I'm a principal at Global Capital Markets. We're a boutique investment bank focused on mergers, acquisition, growth capital. Here's my LinkedIn if you want to connect with me. A little bit about my background. I spent 8 years overseas, a lot of the time between US and China, before hopping into the investment bank where I've been as First Stern Ventures and now Global. I really am happy to be here. This is an exciting panel. I've known some of the Matt and some of the people here for quite some time, and I'm really excited to have a great conversation and to learn from everyone as well.
Thank you. Ryan, next slide, please, Ryan. Mike, why don't you give us a little bio on yourself, please?
Thanks, Mike, and thanks for having me. Hi, everyone. My name is Mike Morales. I'm a tax principal at Abbott Stringham & Lynch, a local CPA firm in the Silicon Valley. I specialize in closely held businesses such as S corporations and LLCs, as well as high net worth individuals. I work with people day in and day out on minimizing their tax bills and figuring out what they owe and when they owe it and what they can do. I have a master's in taxation, and I'm also a licensed CPA. Thanks again for having me.
Of course. And Matt, please.
Well, good morning and thank you. My name is Matt Cohen. I'm a partner at a boutique M&A firm called Synesis Advisors, and I specialize in the sale of privately held companies. Most of the projects that we do at Synesis are B2B service businesses, import companies, some manufacturing, and quite a few projects in licensed trades in the past few years. Most of our deals are under $25 million in sales, with the sweet spot being 5 to 10 million in sales.
Fantastic. Ryan, next slide. So my background is I've been a financial advisor for almost 35 years. I've dealt with a wide range of clients. In any given day, I'm dealing with accountants, attorneys. I've talked to both of those skill sets today, as a matter of fact, dealing with different client needs, one of which is having clients who are at the point they want to sell their business and then kind of directing traffic amongst the professionals. To give you an example, why don't you go to the next slide, Ryan? So I'll give you two key examples. Example number one is I was doing a visit with a physician last week for a very minor, very trivial surgery, and he proceeded to tell me all the idiosyncrasies of what he was going to do in this very minor surgery. And I kind of listened the little bits, like I'm thinking, this is your deal, not mine. And then at the end, either I said or I think I prompted him. I said, how many of these have you done? And he said, yeah, he said, I've done in the thousands. And that's when I started feeling good about the surgeon. Another example occurred literally last Tuesday. I walked into a longtime client's office who owned both a medical practice as well as another medical organization. And she announced that she was in the process of selling the medical organization. And she had an attorney and an accountant, and they were just fine. Everything was going to be fine. And the tone of her voice suggested I got this all under control. So afterwards, I texted her and said, look, I know you have the right people, but humor me. I'm going to send you a series of videos from colleagues of mine that do these types of transactions all the time. Will you at least look at them? And what I've discovered in my career is that in way too many cases, clients will rely on someone who they've been working with for a long time for that reason and that reason only. That the person they're working with, the team they're working with, may or may not have the skill set, but they don't even know the right questions to ask. So this is why this panel discussion is so very important, to give everyone who listens to this, be it live or later, an idea of the kinds of questions to ask. So Ryan, if you can switch over to the page with all of our pictures, I'm going to go through and ask all of our panelists a series of questions. And throughout this, there's a way to communicate with you guys in the audience. We're going to throw up some polling questions. So, Ryan, if you want to go ahead with that,
I'm bringing it back down.
What's that?
I'm going to bring down the slides, so we'll just have everybody's face.
That's fine. Yeah, again, guys, let's not talk to anybody about our hair care products. Sean, let's go with you first. Why don't you tell us, Sean, what are some of the questions a business owner should be asking themselves about selling their business?
Actually, I'd done a bunch of research on hair care products, so this question has kind of caught me by surprise here. I mean, there's so many questions that a business owner should be asking themselves before doing this transaction. I mean, because this is such a major thing in many people's lives. In fact, you'll hear stories of people that have gone through divorces, that have lost pretty much everything to keep that business alive, to grow that business over the years. So, I mean, one of the first questions they should really ask themselves is, what are they going to do post-transaction? Have they really mentally prepared for that transition period of maybe working 60, 80 hours a week to now, hey, now I have this time. Do I have hobbies? Do I have some friends and families, relationships? Do I know what I'm going to be doing post a transition, post an acquisition? So one of the things, ask yourself, what are you going to do after? Also, you have to ask yourself, will this exit give me what I need for the rest of my life or next steps? And that's when, talking to Mike, to yourself, and going, hey, my company's valued in this range based on what my investment banker, my business broker, my M&A advisor, whoever I'm working with, the valuation expert has kind of given me. Now, is that enough to carry on the way I want to live? Or do I need to grow this business a little bit more? Or have I already passed that? And then they need to ask themselves, going to other Mike on the screen, Mike with hair, how do I structure this deal or the tax plan, and what conversations I need to have before, so that when we do this process, that I'm getting the maximum results, and that whatever I'm getting from this transaction, how it's structured, makes sense. And then there's also the conversations of, okay, let me talk to my family about this transaction. There's a long list of items and questions that they should ask themselves. They should take kind of an inventory of their situation before starting along this process, because it is such a time-consuming process, and it is one of those major moments in your life that you may have spent 10 years building up, 20 years building up, 30 years building up, and it's going to seem like that, but it's a grueling 6 to 9 months or however long it takes to get this. So, I mean, I could go on forever, but I don't want to take up everyone's time. And, if it's a hair care product company, I mean, those things sell like that. So don't need to worry about.
All right. So given that one of the things Sean was discussing was valuation, Matt, kind of give us some insight into how small businesses are valued and maybe how the buyer's opinion and the terms differ from a professional valuation report.
Yeah, thank you. So I think most people that own businesses and have put any thought at all into selling it understand that earnings or EBITDA is the gold standard for determining business value. I mean, it measures the company's profitability and financial performance, and it is the primary driver. There's other methods for valuations, which I won't talk about today, but they're equally as important. But professional valuations, they're incredibly important, and professional valuation people help us so much with what they do. What's often not considered, though, are a variety of operational issues that can affect the business's ability to generate that EBITDA going forward. So I want to highlight a couple things that buyers will pick out. We'll look at this through the buyer's lens. What do they see that is risky for them? And I'll just hit a few of them. So we can have a nice EBITDA, you know, and a multiple of that EBITDA and a nice valuation. But when you look at things like sales trends, are sales trends going up, or are we looking at a decline over a period of years? That's a really important factor, because if this business owner is unable to grow the business, how can a new buyer be expected to do that? The second one that I see a lot, particularly among baby boomers, is who are selling, is what management is left in this business after it trades. So we know the owner won't be there, whether they're going to retire or do something new, they're not going to be there. But if they have key managers, key staff responsible that are also not going to stay, that's an incredible risk for a buyer, whether it's a corporate purchaser or an individual who's purchasing the business. And one that really is a big thorn in my side is customer base and customer analysis and customer agreements. So I have a lot of buyers, particularly older ones, that have handshake agreements with their customers. Their contracts they have no teeth. There's quick cancellation clauses. This is a big problem if you're buying a business. How do you know that these customers are going to stick around? And on that same note, what if one customer makes up 10, 20, 30% of sales? What is a buyer supposed to do if that customer leaves? That's an incredible risk for a buyer. And it's often, these items here are often not measured in the business valuation. I guess there's others, but the last one I'll highlight today are financials and quality of financials. A lot of small businesses don't have data. They don't have financial information that allows buyers to really understand what's going on. The seller knows what's going on because it's their business. They have a lot of it in their head. But if the data doesn't support that and tell the story, again, it creates risk for buyers, and it can change what the price is and how the terms are for a deal.
Makes perfect sense. Makes perfect sense. So
Hey, Mike, can I chime in real quick?
Yeah, please.
I think Sean and Matt brought up some great points about the business just as a whole. And one thing that really hits on the nail is you need to sell at the right time in the life cycle of the business. Meaning, if you just started a new office or another section, you just dumped a whole bunch of money into it, and the next year is looking very promising because you're going to have a whole new revenue stream, selling right then and there is not probably ideal, and waiting for that second office or third or the second when you just open to kind of pan out could be very lucrative in waiting out that. So I think they brought up some really important points about the life cycle of the business and where you're at, and in an ideal world, choosing the right time in the growth aspect of the business to sell it.
Excellent.
Can I piggyback on that?
Sure.
But right time, perfect. Reality is it's never the right time.
Exactly.
They never, something happens where, oh, I've been shaping this business to sell. I've been focused on the last 2 years, and some law changes, and they know the next year, or going back to Matt, customer concentration, this one contract's not renewed, or out of nowhere there's sickness or divorce or something. everyone starts planning, but reality is sales normally do not happen at that right time. In fact, the person you'll talk to will shake their head and go, "Oh, if any other time, but I just have to right now." And you're like, so I mean, this goes
It's a
back to
double-edged sword.
planning. Yeah,
Yeah, yeah,
it is.
I agree.
So Mike, shifting a little bit. I mentioned the client that I met with and her set of circumstances. What I'm catching my nose. When, I should say, should a business owner assemble a team to start working on this, and who should be included in that team?
Yeah, so I'm really as soon as possible. I know that sounds corny, but really, ideally, when the decision that you're going to sell the business is made, is when you should start thinking about, tightening up things and getting the right advisors and advisors that have done it, hundreds of times, or, they can do it with their eyes closed, and, the right CPA, attorney, financial advisor, business broker, investment banker. I mean, you really need a whole team, and sometimes people that really want to, dig in, they'll even do a quality of earnings report. So that's just like another layer and valuation, of course. So starting that process is really key, and starting not just when you're about to sell, but really it should be 3 years in advance, almost, in a perfect world. Because what happens is when you go into that, when that sale finally, starts, like the deal's happening, they're going to do a whole bunch of due diligence, and they're going to look back at the last 3 years tax returns, and they're going to want to see clean stuff. And if anything's questionable or you have anything going on, your price is going down. So as soon as possible is what I would say. This way it makes a smooth and successful transaction.
Gotcha.
And Mike just had to, a lot of these experts that work with these transactions, they want to get to know you as early as possible. They
Yep.
want to build that relationship so that when the time is right, you're thinking of them. It's, oh, Matt has helped me and given me advice for the last 3 years on position my company so that it has the best valuation when it's time to go out to market. He's given me all this advice for years. I'm going with Matt when I sell. Or
Mm.
Mike gave me so much financial advice on the tax strategy. When time is right, he's my man. So experts, they want to build those relationships, and they can give so much advice and point you in the right directions and steer you over here and tell you what's going on from their conversations. So don't feel that it's too early to reach out and start having those conversations and start building that team, because I mean, they want to be there early on, and getting their advice early on also really helps everyone. So when the time is right, or if it's not right, people can move fast.
Matt, you want to chime in at all on that before we do it?
Well, I would just say that in most of my closely held projects, which are, small in the scheme of M&A, it's really more a function of the seller's life. What's going on in their life when they want to sell? The kids are gone, they want to move out of state, or, some other unfortunate life event like Sean spoke about earlier affects that. They're not a large professional corporation where the owner can sit back and let the second layer management wait around until these other things happen. So, I mean, I 100% agree that if you can affect change and sell at the right time, that's the way to do it. It's just not so much the reality in the projects that I work on.
Got you. All right. So now Ryan is going to put up a polling question. I would ask everyone in the audience to give us some insight. We're going to go on to a second round of questions, but if we could have everyone look at the polling questions, take 10 seconds, go through them, that'd be really helpful. While people do that, let me tee you up with the next question, Sean. The next question involves something we've kind of been talking about, but not completely. The next question is, the next conversation, not a question. What are some of the most creative deal structures that you have seen used in M&A transactions?
I mean, that's a whole, MBA course right there. You can go on forever of, this amount earnout is tied to this, or this much is rolled over, or this this software, every new state it goes into, you get a piece of that revenue from that state, as long as the revenue is over this amount for this amount of time, where year 1, it's this percentage, year 2, it's this, year 3, and then it tapers off to, even negotiating the employment agreements for what that looks like, and bonuses and titles. And it's crazy how many components can be part of the negotiation based on kind of the meaning of the people involved. There's founders that I've worked with that they really don't care about price and terms. They just care about having the logo of who acquired them on their LinkedIn to share moving forward. And you're sitting there going, you're leaving all this money on the table from these other offers you're saying no to, just because you want this one logo for ego. Okay, I mean, if that's what means a lot to you and that's what's important, great. We'll go in that direction. And then you'll get the other person that super risk adverse, wants all cash on closing, just wants to walk away, or that other person that says, listen, me and my co-founder, we founded this together. I want the cash. He wants the equity in this deal, where we're rolling over this much equity into the new company, and we have the LOI, but we have a separate agreement on the side of how we're going to split the proceeds, and all these things. So, I mean, basically what I'm trying to say is, a lot of people go into negotiations not really understanding all the components that could be discussed. And as they start to understand those components, then it just opens up almost an unlimited um, area that could be discussed, from money now to that second bite of the apple, to titles, to hours committed after the transaction, to this, to that. It can go on forever. So for creative deal structuring that I've been involved with or that I've heard of, I mean, we're talking deals where this bit was put in escrow, or a holdback with this amount tied to new states for software being deployed based on milestones, based on, and it just goes on forever. It's yeah.
Gotcha.
But that's why we're part of deals. That's why we're hired, is to bring that knowledge and expertise of just, hey, these are possibilities, these are options. And then in advance of knowing who we're working with, we know, okay, this is what they value. This is what they put emphasis on in the transaction. So let's focus on that versus these others. And then also talking with, Mike, yourself, of how does that impact post acquisition with what they plan on doing the rest of their life. These earnouts, these things, they're not guarantees.
Right.
They may be worth nothing. This equity portion may go down to 0, or it might be the biggest win from the whole transaction. How does that impact a person that's 65 versus someone that's 30 that's going through this transaction? So it's talking about all these different components, talking to experts, the team, putting the bundle while structuring the deal, and running the process.
Gotcha. Matt, I bet you have more to add on that. And as you do, also talk about how small business transactions are typically financed.
Sure. So in our world, which is smaller deals, half of our deals are done using, the buyers are using SBA 7A money. And I represent sellers. And my partner and I spend a great amount of time, an inordinate amount of time ahead of putting the business on the market, helping the seller understand what the deal looks like through the buyer's lens and how it can be financed. So many businesses don't qualify for 7A for a variety of reasons, for SBA money for a variety of reasons. And when we roll up our sleeves and help conduct an operational analysis and pick out some of those things that I was talking about earlier and get ahead of them and get them out in front, we can avoid risk mitigation strategies. We can avoid putting a business on the market with the expectation that it can be financed by the SBA when it's very, very unlikely, or we know for a fact that it can't. So half our deals 7A if it qualifies, The other half are lately private equity backed ventures or corporate purchases. So in those cases, they have their own money, or they have their own lending facility, or they're borrowing against their own balance sheet. And they have a lot more control of how they pay for things, what they pay for things, than a buyer that's relying on 7A. And I think in a minute, we're going to talk about risk mitigation strategies, and I'll talk about how some of those are really subject to the type of financing that's available.
Got you. Mike, give us an insight into, beyond the financial aspects, what other things need to be considered pre-sale? What other dimensions beyond just finances?
Yeah, so, beyond, pre-sale, what you need to start thinking about, even though the sale hasn't gone through, is estate planning and legacy planning. What are you going to be doing with this money? What I've noticed when people sell, their businesses for a lot of money is they didn't have, an estate tax issue. And then they sell and make a lot of money, and now they have a state tax issue. So, you're totally changing the makeup of your tax profile, when you get that windfall, which is great, but you just add a lot more complexities into your tax situation that you need to start paying a lot more attention to. And why? Because it's your money, for one, and two, it's your family's money and whatever's left for when you're gone. Because the government wants some of that. State tax is 40%, which is pretty serious. So estate planning is really key. So thinking about that. And then I know this is kind of philosophical, but what Sean was saying earlier is, what are you going to do after you're done selling the business? You're going to have a stockpile of money. You need to go talk to Mike Ross here and figure out what to do with the money. And then you also need to talk to me about, after you talk to Mike, how are you going to be tax efficient with that money, right? And it's, again, you're changing your whole profile. What are you going to be doing? And then along the sale, while you're going into the pre-sale stuff, besides the legacy and estate planning, what I like to try to remind my clients as they're going into these discussions is, are you going to stay in the business, or are you out? You just want the cash? Are you going to try to do, earn out? What's the plan? And then, have you considered non-compete arrangements? Are you are you going to open shop, across the Bay Area? Are you going to go to another state, start over? And then the new thing with private equity is equity rollover, meaning people giving up some of their equity to roll into the new company that's buying them, and them having a stake in this new company. It's pretty popular right now. And, is that something they're even interested in? Maybe they just want to get out and be done and take the cash and run. And some people, like Matt and Sean, have said that they've been in this business for years and founders, and they don't really want to give up everything yet. So they'll give up 70% or 80%, depending on the deal of term. But I actually would like to hear what Sean and Matt have to say about the equity rollover stuff, because it's pretty hot right now.
Yeah, let's kind of go off on a tangent. Matt, you and I have talked about this before, the increasing presence of private equity into deal structures. And then Sean, I'll have you make comments on that too. Matt, what do you see in your world in terms of private equity acquisition stuff?
Well, we've certainly seen them come, what I would say is downstream. I've been at this for over 20 years, and I've done north of 100 transactions. And in the last maybe 5 years, I've never seen so many private equity or private equity backed, what we call search funders, looking at our projects, which have $500,000, $1 million, $2 million in EBITDA. They just used to look at so much larger projects, and they can be really excellent buyers. The problem is that the businesses that I sell often don't have the data. They don't have the infrastructure that these folks require. These are professionally trained, highly educated people who are expecting things to be presented in a certain way. And a lot of the businesses that I sell just don't have that information, don't have that data, don't have that management processes in place, which can make it really tricky to get a deal done with them.
Gotcha. Sean, you have some comments?
No, I especially as Matt had mentioned the search funds, that my inbox is getting filled with people saying, "Hey, I backed by this family office," or "I just graduated with an MBA from this, and I'm looking for this type of company. And I mean, I was on 2 calls yesterday with different search funders, and they were just asking, how can I get access to these deals? I seem to use the same, Grata and these data sets that everyone's using, and emailing these business owners, and they say, if they do get in contact with the business owner is saying, yeah, I get 10 of these emails a day, and my phone, it's just, they're having real difficulty separating themselves and standing out amongst the crowd. But yeah, going down street, like Matt said, I mean, there's private equity groups a couple years back. We won't look at anything under 2 million EBITDA. Now it's, oh, well, we got this platform. We're looking for something to add to it. 500,000 EBITDA we'll take a look at. I mean, there's just so much dry powder on the side, and these people sitting on money that need to deploy, that businesses that a few years ago would never have been looked at are now getting inundated with emails from these groups. And that's actually one thing that I kind of want to mention to business owners. If you get these emails, it doesn't mean that they want to buy your company. And that's something that a business owner will come in, oh yeah, I got so much interest from private. Oh, I'm like, no, you're on an email list, and that email list got passed around, and there's some analyst, there's someone in India or the Philippines that's job is just to email everyone in these geographic areas and these sectors and that, and they'll take a meeting because they need to have so many meetings every quarter for the partners there to check off on the work the analysts are doing, whatever it is. But take it as a grain of salt that it's not a sale, that it's just an email. And right now it's easier than ever to email people. So just keep that in mind. So I don't know, kind of went off on a tangent there.
I have something to add. And Sean's 100% right. I represent sellers, right? That's my job. And if you respond to a single search fund person or search fund outfit, and you think you're going to get a deal done without having someone make a market for your business and create competition, you're putting yourself at a huge disadvantage. You need someone like Sean or myself to package the business, organize the information, and create competition. The other thing I'll say is that a lot of these folks, these search funders, it's not their money. And if you're not driving the bus, if you're a passenger, you're not a good buyer, really. So my partner and I, what we call stress test our buyers. We insist that they bring in their financial partners at the very beginning of the process, and that their financial backers, the big PE firm that they worked at for 2 years after they got out of business school, we want those folks to look at the deal at the same time, so that we're not doing everything all over again or having them walk away because the backer says, well, I would never do this.
So we got a question in the Q&A, and I'll encourage everyone to use the Q&A if they'd like to, from a buddy of mine who actually is a valuation guy. And the question was, are there certain industries, and this is for all three of you guys, but especially Matt and Sean, are there certain industries that search funds are either focused on or not focused on? Is there a sense of direction, or is it all over the map?
I mean, the things that are in my inbox, they're literally all over the map, and they all have the same idea. We're looking for that first company, and then we want to acquire 3 or 4 others in the space, bundle them together, and then flip into a private equity group in 5 years. And I mean, just recently I've had one for a logistics company, a search funder for logistics companies, one for software as a service companies, one that was looking to do dental roll up, one that I've had them all over. But whoever, I guess the commonality is the search funder that's doing it says, this is my background, I have experience in this industry, and this is what I can bring to the table, and this is why you should introduce me to anyone that that's in this sector or business or this size and that. But I've seen search funders look for everything, and they just try to play in that spot that most of the time too small for private equity and too big for mom and pop to buy, that little niche.
Matt, do you have other thoughts?
Well, it's been the licensed trades In the last 4 or 5 years, my partner Randy and I have done projects in landscaping, roofing, HVAC, flooring, plumbing, janitorial. And these are the kinds of deals that we rarely did for the first 15 or however many years of my career. So a lot of these businesses are being sold to PE-backed entities, big ones that you read about in the Wall Street Journal, and they're, they have a plumbing roll-up now, and, we're selling them a plumbing company to bolt onto that.
So oddly enough, I'm in a couple different PE funds, and that was their spiel is they were going, be a private equity fund. I own some kind of lawn service business in the Northeast. So I get what you're saying. I'm seeing you shake your head, Mike. You want to throw your
Yeah,
comments?
yeah. So it seems a little service focused is what I'm noticing. And I mean, I don't do all the deals. I just help with my clients. But what I'm noticing is the roll up, like Sean and Matt were saying, where they're taking, a couple landscaping small businesses, rolling it up together, making it, in sync and in line with all each other, the businesses, and then selling all that to a bigger company. It seems also the time on the deal when PE gets in is 5 to 7 years. That's just, just generally speaking, because they don't buy it and try to flip it in 2 years. No, they want to do some work and make some changes and make it a little more profitable, so it looks better on paper, and then sell it up and make some profit. And also gets the people that put the money in out of the deal if they want to, in that 5-7 year investment, or they roll into the next deal depending on what the fund is doing. But yeah, doctors, landscapers, a lot of service, plumbing, all that stuff. If they can buy a couple of the businesses, combine them into one, it's pretty valuable.
We could do an entire panel discussion on
Yes.
private equity buys, and I have my own commentary around that. That's not terrific. Matt, we got another question, which I really think fits your profile. All right, you represent the sellers. Are there questions that are coming from the buyers that make you recognize that the buyer is serious? Is there a series of questions that you want to see from buyers to know they're serious?
Well, I run a process where I'm able to determine pretty quickly if the buyer is serious. It's how they deal with me first. I don't involve my clients for quite a while. I'm speaking to the buyer. I'm looking at their financials. I want to make sure they have adequate capital and liquidity to do the deal. I'm looking at their resume. I'm looking at their business model, at the deals they've done, if they're institutional. And to pass through my stress test or my qualification process, if I introduce them to the seller, they're serious. Otherwise, they don't ever get to talk to the seller.
Gotcha. All right, let's shift our attention here because this is a great conversation, but we got to get some closure on a couple things. Let's go to the risk side of this. Sean, what are the potential risks and downsides of an M&A transaction? I think I know the answer, but I'd like to get your perspective.
Well, I mean, there's infinite numbers of
Yeah.
risk in that. I mean, if people know that you're thinking of selling your business and next thing you know, your competition comes and poach all your clients or your employees, or during this transaction, you get sidetracked because of the involvement it takes. Most people have no idea the amount of hours and work that goes into a transaction. And maybe the company starts missing milestones. Some of the metrics go in the wrong direction. Company's valuation goes down. Maybe the added stress takes a toll on your health, your body because of this 6 to 9 month transaction, or however long it's taken, and those emotional ups and downs. I mean, the mental health is a serious thing in these transactions. So there's so many risks from financial, emotional, relationship, the core of the business itself that come into play during one of these transactions that you just can't pick one. There's infinite numbers of areas that could result in some, catastrophic things, to be honest.
So Matt, I'm gonna have you weigh in on this. But before I do, I think Ryan has another polling question that he wants to throw out. I think I missed it after Mike spoke because we went off on that tangent. So Ryan, if you want to throw a poll out there, go right ahead.
Sean couldn't have said it better.
Yeah.
life happens, and it is a long process, and clients get burned out, particularly if you enter into an agreement and you go through a due diligence and a quality of earnings, and months go by and the buyer walks. And the seller had already thought about how they were going to retire. It can really, really impact their ability to do it again and to support us as the intermediaries the way we need to be supported. It's a partnership. We don't do this alone in any way. I've had sellers pass away during deals. I've had their spouses pass away during deals. There's been the pandemic. I mean, lots of things can happen that can crater deals and really impact the mental health of sellers. We are therapists, really. I mean, half of our job is emotional support and just providing, some therapy to our clients.
So I think you just answered this question, but the question I was going to ask is, how do buyers kind of mitigate their risk in the transaction? I think you've already hit that, but you want to reinforce it one more time?
This for Matt?
Yeah.
Okay. I mean, there's quite a few structures, and again, some structures were limited based on the financing source. The SBA just doesn't allow certain deal structures. But the one that I find really useful and sellers can usually swallow is the escrow holdback. So some portion of the proceeds are held in escrow for a specific period of time against reps and warranties. That's pretty palatable. And then there's earnouts, there's seller notes with rights of offset if certain things happen. Sometimes we can get those done. Sometimes it's just a matter of lowering the deal price. The buyer says, look, the seller says, I don't want an earnout. It's like, okay, well, the deal price has to come down to mitigate this risk.
Makes sense.
Could I add something to that too?
Yeah, of course.
And buyers, I mean, a way to mitigate the risk also is to get to know who's representing the seller. I mean, to be honest, getting to know someone like Matt, when getting to know Matt, they're gonna, okay, this person Matt's representing, he must have done the due diligence before taking on this client.
I don't always represent my sellers in that way. Like, we don't always know what they're up to, and we don't take on that risk necessarily, right? They hide things from us too.
Trying to put you on a pedestal here, Matt. Come
Buyer
on.
beware. But you're right. Like, we don't take crappy, clients and crappy projects.
Yeah.
And I'm sure you don't either, Sean. We do our best to take motivated sellers with good businesses.
I mean, one of our things, because for us, we're so highly success focused, right? Yes, we charge retainers. Retainers, that is one way that we vet our clients. If they don't pay retainers, that's a way for us to know they're not serious. Another is that we're success focused. So that makes it so we've done our due diligence on the client before we want to take them on. And those two things, and plus all the preparation that goes in, the data and the market, all these things, that's alerting the buyer, okay, they're serious, or they wouldn't have hired this group to represent them. And we have to trust that this group's done their due diligence on the client. Now, there's always those situations at the 11th hour where the greatest deal's on the table and the seller still goes, I'm out of here, I'm walking away. But because of all those things that have happened before, that risk is really mitigated quite a bit by the whole process taking place. So
Mike, why don't you walk through some case studies or examples of where well-executed exit strategies led to better outcomes for the seller? Give us some insight into what you've seen as the years have gone by.
Yeah, so generally speaking, the deal structure is everything, obviously, but in today's environment, most of it is a stock sale legally, and for tax purposes, it's an asset sale, meaning the buyer wants to buy the assets from a tax standpoint, so they get a step up in basis. And the seller usually just wants to sell their stock so they can just have capital gain, but that's not usually what the buyer wants. So in essence, the seller ends up having some ordinary income for selling their assets from inventory, depreciation, write-offs, and accounts receivable. But what really goes into it is, are they getting made whole for those extra taxes on the ordinary income then versus the stock sale? Sometimes it's pretty minimal for the overall, deal, but sometimes it's very, very wild swings. If you're gonna have to pick up, 4 or 5 million of ordinary income from AR collections, well, that's gonna swing things in a different manner than having $1 million in AR. And then other things to consider is, again, you know, case studies that have gone well is people that have really good books and records. So, for example, is state tax compliance. It's like, oh, we're not going to file there because we don't want to deal with it, right? That's what we hear all the time. Oh, okay, and next year comes, oh, we still don't want to deal with it. We'll do it next year, Mike. Well, the next year they go into the sale, and under due diligence, they go, hey, what's your exposure to state filings? And oh, we didn't file in that state because we didn't feel like it was necessary. Now, the buyer is now gonna have to take on that liability, deal with the state compliance, file those 2 back returns, file the current year, and you just like threw something, a wrench in, in the wheel, and now it's like the buyer's gonna have some more questions. So the most successful stories I've had are people that have, everything in line, and when they're going to due diligence, like, oh, you need that? Boom, here it is. Oh, we do this because this is our procedure. And that's why, working with Matt and Sean beforehand, well in advance, is also good because they're going to kind of ask you some questions that the seller is going to ask, and being ready for those questions. And I even had them. I had someone who's going through a deal right now, and they asked about a specific journal entry like 2 years ago, and it was really interesting. But they're just checking things, and what were they checking? They were making sure that the S corporation, one class of stock, didn't get skewed, because everything has to be pro rata based on ownerships. And if you mess that up in one of the previous years they're looking at, you might blow the whole deal, because now you don't have a valid S election, and now you're a C corp, and that changes everything for the buyer. And one other successful thing I want to really bring up that's very popular in today's tax environment is the California, specific to California, but California pass-through entity tax credit. Basically, if you do an asset sale, the business can deduct the pass-through entity tax for the shareholders, for S corporation. So basically, they're getting a 37% deduction on every dollar they're paying for the pass-through entity tax. And what ends up for the shareholders is they have California prepaid taxes because it passes through out to them. So, and it could be a substantial deduction and a substantial tax savings by doing that. And what really matters is making sure you're hitting that election and doing the right, the right election at the right time. Because if you miss it, if you don't hit that 615 first estimate and you don't do it right, you blow in the election. And if you sell for millions and millions and you can't do the election, you'd have lost out on a lot of money. That's just easy money. So pass through any tax. And of course, I'm talking about California, but they have it almost in every state now. And what the pass through any tax came from was a $10,000 SALT cap for some itemized deduction. So in 2018, they limited how much you can deduct for state taxes to $10,000. And states have came out and done this workaround to allow you to get that deduction through the business and pass through individually. So that is huge. And having a CPA be on top of that, and the planning that goes into that, is also key. And then one last tangent thing besides state taxes that they're going to look at, the buyer, is state taxes, use taxes, unclaimed property taxes that no one wants to talk about. I mean, they're going to ask these questions at some point during the deal, and you didn't need to be ready to answer them. So the more prepared you are, the smoother the transaction, the more successful.
Excellent. All right, let's go around the virtual table one last time. We've been working on this thing for about 50 minutes. Let's Sean, let's start with you, Sean. Number one is any closing thoughts, and number two, how do people get a hold of you?
Never too early to prepare for one of these transactions. I mean, honestly, even if you think it's 5 years down the line, start thinking today about the team, that exit, that amount that you want, what you want to do post with your life. Keep those relationships now so you have those later on. So more than anything, plan early. Best way to get a hold of me, if you're watching the video, scan the QR code that goes to my LinkedIn, connect with me there. If not, my email is sf@globalcapitalmarkets.com. Look forward to connect with everyone and just having a conversation, learn more about your business and what you're working on.
Fantastic. Matt?
Well, I get a lot of, I have a buyer, friendly competitor. I have a buyer who's contacted me. If you have one buyer, you don't have that buyer, they have you. So you really need to find someone to help you organize your data, put together a thoughtful marketing plan and execute on that marketing plan to create competition and to hold buyers, to have them put their best foot forward. That's my thought. To contact me, our website, synesis-advisors.com, all our data is there. I would also say you need to speak to your investment advisor and your accountant early. You want to know what you're going to end up with, because I can help you understand what your business is going to trade for and what the terms are likely to be. I don't know what you're going to end up with, though. That's a function of your personal tax picture and your personal financial situation. So folks like the two mics that are on the screen here, you want to talk to them before you even talk to me or Sean.
Mike with hair.
Hey, yeah, my final comments is, if you're gonna sell or even thinking about it, start preparing now. And be ready for those questions when you're in those conversations, and come prepared, because that's only gonna put more money in your pocket. And then the other thing is not only being prepared, but having the right team. Just because you work with someone for 15, 20 years doesn't mean they're the right person to go to the sale. And it's pretty simple. If you're not sure, just ask them, how many sales have you done? What do you offer to your clients when they're in the transaction? How do you support them? Just kind of pick their brain. If they don't have quick answers that you like, probably need to check out some more advisors. You can catch me on our website at aslcpa.com, and I'm also on LinkedIn. And my email is mmorales@aslcpa.com.
Fantastic. Guys, thank you very much. This was really helpful. We've answered a lot of questions. Everyone in the audience knows how to get a hold of all of us. Ryan, I'll pass it back to you, sir.
Wonderful. So thank you everybody for joining. Thank you to our panelists, Mike, everybody with very little hair, by the way. This has been a great conversation. There was a lot of engagement as well from the audience side. Thank you for the audience for spending your time with us. We know your time is valuable, and we appreciate you joining in. Also, thank you, Julia, and the wealth management team at Lattice for helping us put this on. It's been really excellent working with everybody. We will make sure that everybody's connected with the panelists as they did in their vote. We'll make sure that happens. And then we want to plan more webinars. So we're just looking at the next month and seeing, October sounds great for something spooky. So let's talk about death and taxes. Tentatively, we're looking at the 22nd of October. So plan that in your calendars. Once again, thank you to everybody for joining, and we will see you next time. Let me just end this, and then we will end the webinar there. All right. Bye, everybody. We'll see you later.
Thanks.
Thanks, Mike.
Guys,
thanks, Ryan. Thanks,
again,
everyone.
everybody. Very helpful.